Good morning, Jamie here, your favorite CPA, financial literacy coach, and profit strategist. Today, we're going to be talking financial literacy. We are kind of following up on what we did last week. So if you missed it, last week we did a whole discussion on the balance sheet and what it is. So that's a really good precursor to this. Or if you want to go back and listen to it after you watch this, it's available on my YouTube channel. Wherever you're watching me from today, say hi. You might be watching me on my YouTube channel. I am live over there, my Jamie Trull YouTube channel. Make sure to like and subscribe, please. You may be watching me from Financial Literacy for Women Business Owners, my Facebook group, or maybe from my Facebook page. So wherever you are, say hey, tell me where you are tuning in from. Okay, I see Charlotte. Hi, guys. I see some people joining. Awesome. Good morning. It is, what day is it? It's Wednesday, June 23rd, and we are live. And I am excited to be here, you guys. Hope everybody is doing well. So I'm just going to let everybody join for a minute and give a couple of announcements. Next week, I will not be here, but we are planning to have a special event. So next week, my team is doing a team retreat, which I am super, super excited about because some of my team members, you guys, I have never met in person. So I'm really, really excited about that. Our team's going to get together. We're getting together in Asheville, North Carolina, which is going to be amazing. For whatever reason, a lot of my team members live in North Carolina. I'm over in Nashville, Tennessee, but we're going to Asheville. And we're going to be hanging out for a couple of days and having meetings and doing some fun things. And we're going to try also to get online and have a little bit of a party with you guys. So be watching the group for that announcement of when we will be live so you can meet the rest of my team. We might be doing some giveaways just as a hint. So more to come on that, but it will not be at our normal time because I will be driving in the car back home next Wednesday at 10 a.m. So it will be Tuesday, probably Tuesday afternoon is my guess. Okay, so today we are going to be talking about depreciation. And I get a lot of questions about depreciation, so I thought it would be good to do an overview. We're not going to go super in depth and start talking about various different depreciation methodologies or anything like that. Don't worry. But we are going to give an overview of what depreciation is and why it matters, because I think it's one of those things when if you're looking at your, financial statements or you're looking at your tax return and you're like, what is this, right? Or a lot of the questions that I get are often around, well, why is my profit this, but my cash is completely different? And depreciation is one of the things that can cause that mismatch between your paper profit, i.e. like what your tax return says your profit in your business is, and what your actual cash in or out is, right? And generally, depreciation is a timing difference. That's kind of how it generally works. So if you missed my live last week, we did it on the balance sheet, and we talked about the fact that the balance sheet has three different sections. You've got your assets, which are what you what you own, your liabilities, which are what you owe, and your equity, which is your kind of ownership interest in the business. So when we're talking about depreciation, we're talking about assets, okay? So what is an asset? I think this is also a thing. Is everything you buy an asset? Well, no. An asset generally is something that you are intending to use over 1 year, like more than 1 year, for more than 1 year. So it's typically going to be an actual thing, right? Maybe it's machinery, maybe it's hardware like computer or something like that. Maybe it is even a car would be considered an asset if you're buying it under your business. So there's various different things that would be considered to be assets. And so these things are typically going to be higher dollar amounts too. A lot of people ask that question around, well, when is it considered an asset? An asset is really not necessarily a dollar amount, but oftentimes people can kind of use the de minimis exception, which basically if it's under $2,500, a lot of people just don't worry about calling it an asset. Instead, what they do is they just expense it all at one time. So what's the difference there? Well, when you buy something, okay, let's say you're putting out cash to buy something, and you're trying to figure out what does this mean? I just bought something, maybe it's something for $10,000. It's a piece of machinery for your business. It's going to help you over multiple years. It costs $10,000 upfront. And you're thinking, well, don't I get that deduction the year that I buy it, right? Because cash, I paid the whole $10,000 this year. So shouldn't I be able to deduct that as an expense on my taxes this year? Not necessarily. And it's because of the way it actually works with assets and depreciation. Now, there are a lot of exceptions. The IRS code has about 1 million different exceptions for these things. So I'm going to talk theoretically, and then I'm going to give you a couple of pointers that you might want to think about when you're trying to make a decision on how to handle some of these things. But overall, if you buy that machinery and equipment, the technical answer, right, before we get to these exceptions, is that that's an asset that goes on your balance sheet. So it doesn't go on your P&L. It doesn't show up as an expense right away. It will eventually, but it doesn't go there right away. Instead, it goes directly to your balance sheet, which is where your assets are sitting. So that $10,000 will be sitting as a machinery asset, something like that, right? Now, it would sit there forever, right? It would just sit on the balance sheet. But how do we get the deduction? How do we get that running through and hitting our profit and loss statement, right? Well, the way that you get that to happen is accumulated depreciation. It's depreciating the asset. What does that mean? Well, your asset is going to lose value over time, right? This asset is meant to last for multiple years. You're going to buy it. Let's use the example of let's see, what's it? I think like some kind of machine that you're going to buy, and it's going to last you, let's say it's 5 years or so. And the IRS has tables from a tax perspective of how long they expect things to last. Most of the time it's 3, 5, or 7 years that you're going to be depreciating the asset over. Now, that may or may not align with how long you actually think you're going to use it, right? But that's generally what the tax depreciation will be. So let's say you have a $10,000 asset. Yeah, we can use a computer. Let's say it's an expensive computer, because if it gets kind of lower in price, in practicality, most people probably expense their computers the year that you buy them. But you have the option not to. So let's say you get like a mega supercomputer and it's like $5,000 for this like fancy computer, and you're like, well, what do I do with it? So a computer life from the IRS would be 5 years from the IRS tables. So if it's a $5,000 computer, you then have the ability, right? Yeah, that's a good example too. Maybe not. Maybe $5,000 office copy machine makes a bigger makes more sense. I have no idea how much a copy machine costs. Actually, it might be way more or way less than that. I have no idea. We're gonna go with $5,000 office copy machine or super expensive computer, right? And so you're trying to figure out like, okay, well, can I just expense all of this at one time? Technically, that's an asset. It goes on your balance sheet. If you were to depreciate it straight line, and we're not, again, there are a couple different methodologies that the IRS allows, which is why it's so important to work with a CPA, especially if you are, talking about if you have assets of any kind, please work with a CPA because this gets tricky. But let's say we do straight line, which means the same amount every year over 5 years. $5,000 over 5 years is $1,000 a year. So over that life of 5 years that we're sort of expecting, or the IRS at least expects that copy machine to last, right? We're going to be able to expense $1,000 every single year, okay? Now, what's interesting here is the IRS allows a lot of flexibility in terms of there's something called bonus depreciation. There's also something called Section 179. Both of those ultimately serve to give some exceptions to this rule, meaning you can actually deduct sometimes the full amount of the thing you buy in the year you bought it. And what's really interesting, and if you hear nothing else that I'm saying today, I want you to hear this and think about this. And I'm actually going to throw up a spreadsheet because I think it is that important. I see most business owners trying to deduct as much as they can in the first year. Right? So most of the time you're going to say, well, I want to deduct. I just spent $5,000. I want to be able to deduct that. And I understand that because you're going to save the most in taxes. Like you're going to save in taxes that year. It's going to help you save taxes in the year you're in, the more you can deduct in that year, right? Because you're paying taxes off of your revenue minus your deductible expenses. So there's a lot of people trying to get as much as they can into this 1 year. But here's the thing. We have got to have some foresight to the future when we make these decisions. And I think that is why it's so important to work with somebody, a CPA, who can help you with some of this decision making, especially if you're talking about a car. People are asking questions all over, like about, fully deducting a car and things like that in the first year. Like you might, in some cases, you may be able to do that. Yes. Number one, it has to be for business purposes, right? You can only qualify the percentage you're using it for business as a business expense. But also, it may not be the best idea to recognize that all in 1 year. And so you don't want to be the one making those decisions, because ultimately it's a whole calculation and it's going to be on a case-by-case basis. I cannot tell you what is best for you. I would have to have a plethora of information about your situation to tell you what's best for you. So if you're thinking about buying a car or a big piece of machinery or something like that, make sure you're working with a CPA or an EA or somebody really well versed in how this is going to affect you from a tax perspective, because making the wrong decision can be thousands of dollars. So I'm just going to show you really quickly what I mean by this. Hang on, let me find my share screen, because I think for me, seeing numbers really helps. So I did this little table just this morning because I thought it might be helpful to just, oops, I zoomed in way, you guys, okay. I did this little table and hang on, I just want to make sure you can see the full thing. Okay, so I did this little table for you guys where it kind of gives you an indication of what I mean here. And specifically, like if you're generally making the same amount of money every single year and you expect to generally make that same amount of money, well, maybe deducting it all up front is totally fine, right? Because it's not really going to have a major impact on you to do that. But most business owners, I would imagine, self-included, expect to grow your business over time and expect to grow your profits over time, meaning that you will also be in a higher marginal tax rate later on than you are now if your business is consistently growing. So I wanted to give an example, and this is for a $50,000 asset. I'll do it for the $5,000 asset as well, but I wanted to kind of show you a stark example of why this matters, right? And why working with a CPA matters. Oftentimes, again, we're going to try, let's say year one, maybe your business profit is around $75,000 or so, and your marginal tax rate is then 12%. This is just using the marginal tax rates based on what they are now. Well, if you deduct it all in the first year, the whole amount of that $50,000, if you expense it all in 1 year using bonus depreciation or section 179 or something like that, if you're able to do that, then you're going to save $6,000. That $50,000 purchase is going to save you $6,000. So remember, right? This is also a reminder to to people who are saying, well, I want to buy a car, and even if it's 100% for business purposes and it's a $50,000 car, right? You're not getting a free car. You're saving $6,000 on that car. It's not nothing, but I've heard a lot of people saying, well, I'm going to buy this, Mercedes G-Wagon and things like that. I'm like, guys, you're not getting a free car, even if you're using it 100% for business purposes. You're getting a tax deduction on it, which means you take the amount, that expense, times your tax rate. And that's what you're actually going to be saving buying it as a business asset versus a personal asset. But again, it matters how you use it, not just where you buy it. So, but let's say we bought it all in 1 year. Yay, we saved $6,000 in taxes this year. Well, that's great. But let's say we expect to steadily grow our business over the next 5 years, right? And each time we're jumping up a tax bracket. All right, now this is a pretty extreme example, but you guys are smart cookies. So I don't think that this is out of the realm of possibility, especially if you're in early stages of your business right now. A lot of times we buy assets in the early stages of our business, expecting them to help our business grow later, right? If you're buying machinery and equipment, maybe it will help you scale to this level within 5 years, okay? So let's look, now we've got marginal tax rate. It's jumping, this is just jumping one bracket to the next each time, okay? And you can see if you took that $50,000, right, and you took $10,000 a year, this is what your tax savings would be, okay? So you get a $10,000 tax deduction, but a $10,000 tax deduction at a 12% rate is only $1,200. A $10,000 tax deduction at a 35% rate is $3,500 in tax savings. That means if we were just to be taking our time with it and saying, well, I'm not going to worry so much about reducing my taxes this year. I'm going to look at what makes the most sense over the long term. Well, you can see what makes the most sense over the long term in this specific situation. Again, your situation may be different. But let me show this. I mean, $50,000, you guys might not be buying $50,000 assets, I don't know, but maybe it is that $5,000 coffee machine. Still double, more than double, right? That you're gonna get as tax savings if you were to take it over time. Now, there is also kind of a de minimis here where if it's really small, it's probably not gonna make a ton of sense if you have a $500 thing that you bought to do the work of, you know, depreciating a very small amount year over year over year, right? Like that probably isn't worth the extra amount you would pay even your accountant to deal with depreciating this asset. So I probably wouldn't do it. And again, most of the time with these smaller assets, it can make sense to do it all in 1 year. But as those assets get larger, you can see that it can make a fairly big difference. And this is just something I want people to think about when it comes to depreciation, because I so often see the focus being on how do I save money now, not how do I save the most money in general, right? And there is obviously, there's a time value of money. Money now is better than money five years from now, but a lot more money, it can make sense to do this a little bit differently. So there's a lot of strategic decisions when it comes to depreciation and how it works. But ultimately what it's doing is it's taking that total, you know, original cost that you paid for that asset, and it's reducing it each and every year until eventually it's not on your balance sheet anymore, right? And it's all run through your P&L. So that's kind of how that interplay happens, right? Your asset, as it starts coming off of your balance sheet, it will go, you know, $1,000. Let's say it's this $5,000 asset, so $1,000 a month or a year. $1,000 a year will be going to expenses that you can deduct. So take that $1,000 times your marginal tax rate. That's the savings that you're getting from it. So again, if you're expecting your business to grow, sometimes it makes sense to be a little bit patient and take the longer route and not take that bonus depreciation, not take that Section 179. And I would have that conversation with your tax accountant to say, is the most important thing how much you save over time? Or is the most important thing this year's taxes, how do I save the most, right? And also, I mean, I'll kind of plug, you know, the fact that I'm a really big proponent of saving for your taxes over time so that you don't get to that situation where you're like, well, I don't have the money to pay my taxes this year, so I've got to deduct as much as I possibly can, right? If you're actively saving for your taxes, then you can make those better strategic decisions over the long haul, and you're not like, you know, kind of siloed into doing something that may not be the best over the long term, but because you don't have the cash, it's your only option. Let's see. Yeah, so what will happen in that case typically, right, is if you're trading it in every couple of years, you have to look at what the tax depreciation is. On a lot of, again, it's usually, for IRS, it's usually 3, 5, or 7 years that you're going to depreciate over. They also have an option too, just to mention this, for what's called maker's depreciation. So I talked about straight line, which is basically saying $5,000 asset over 5 years is $1,000 a year. Makers is kind of a little bit more like how a mortgage works, where makers allows you to deduct a higher amount early up, but not the full amount, right? So it's a higher amount, and then as you know, the years go, you'll deduct less and less. But again, if you're expecting your income to, I mean, that's better than taking it all in 1 year maybe, but if you're expecting your income to be continually growing and therefore your tax rate to be continually growing, it can make sense to spread it straight line to get the most deduction in those outer years, the years that are farthest from now. But if you're trading it in every couple of years, right? If you get to the point where you trade something in and there's an amount on your balance sheet, right? And this is a great question, Angie. So let's say 3 years in, so you bought a $5,000 thing, and then 3 years in, you're like, actually, I don't need this anymore. Maybe it's $2,000 is still sitting on your balance sheet. At that point, you would take that full $2,000 when you got rid of, you know, that asset that you have. You take that full $1,000 and it would run through your P&L. Now, if you sell it and you get some money, it's only the difference. So let's say you had $2,000 still sitting there, and you were able to sell that asset for $500. Then you're going to take essentially $1,500. $100 is going to become the expense that runs through your balance sheet to kind of remove that asset from it. And then you put the new one back on, right? And do kind of the whole thing over again, if that makes sense. So generally, no. Generally, no, you can't change it, right? Because the total is what the total is. So if you, well, I take that back. Going that way, like you definitely can't obviously take it all in 1 year and then decide you're going to spread it. Maybe if you go back and like amend all your previous tax returns, but I wouldn't recommend that. As far as changing it, if you do lump sum, maybe it depends on how you took it early. Like it depends on, again, was it bonus depreciation that you took? Was it 179 that you took? But typically the best thing is to pick a method and stick with it and be consistent with that method. You can do different assets sometimes at different methodologies, but it's generally best to have a methodology with which you apply that. And also similarly, if you're gonna say, okay, well, under $2,500, we always just expense the full thing and don't put it as an asset on our balance sheet, then be consistent with that, right? Because if you're audited and then you've got some things that you put on the balance sheet that are like $700 and some things you expense that are like $2,500, and again, these are only assets, right? Things that are expected to last more than 1 year. These aren't like supplies or anything like that. Then I would be cognizant of that. Yes, I did. So I was talking a little bit about, there's a couple different ways, Cheryl. There's bonus depreciation, there's Section 179 to take your depreciation early, but that doesn't mean it's the best thing to do. So I went over a little spreadsheet I made. So go back and check that out because it might be interesting to you. And again, I am such a big proponent of business owners not making these decisions on their own because there's a lot of things to consider about your personal situation, right? And that is going to highly factor in, and what is most important to you is going to highly factor in to your decision around whether to do that or not. I will say, obviously, depreciation is kind of a pain, right? It's kind of a pain to track and all of that. I get a lot of questions too. People ask me, well, how do I record this? Like, right? Because if you're doing your own QuickBooks, if you have a bookkeeper, your bookkeeper should be doing these adjustments, right? Or if you're doing your own bookkeeping, your tax preparer, assuming hopefully you're not doing your taxes as well, your tax preparer should be providing you when they do your taxes with some adjusting entries that you would then go put into your books, including things like depreciation, right? Because otherwise, if you don't ever record depreciation on your books, you're always going to have that asset sitting at full value, and you're not going to be recognizing that through your P&L, and it's not going to be showing up in your equity. So it is important to make sure that you're recording depreciation in congruence with what they are doing for your tax return. That is my recommendation. I think that just simplifies everything, and it makes sure that there's one version of the truth, right? You don't have a books versus tax. Now, bigger companies absolutely do that. Absolutely, they do. But most of the time for smaller companies, it makes sense for books, for the things that you're keeping your books for, to be the same as what you would do for taxes. I will say something really interesting from like kind of the corporate perspective, because I worked for Coca-Cola for 10 years. And so I worked a lot in kind of strategy around, profitability. And so what was really interesting is that, and this was a shift for me to see how small business owners do it. In big business, most of the time, they're trying to spread things over time versus deduct it all at once. Part of that's also for comparability year over year, right? Because it's hard to compare financial statements when you have like some really big expenses that you took in certain years. But also, again, it's because usually that's going to be better for kind of profitability as a whole over the long term. And so big businesses they don't like this kind of thing. They want it to be spread out over time. So in general, outside of really small things, we typically were looking to see how we could spread things out and depreciate them over a period of time instead of taking them all at once. Then I went to work with small business owners, and they were like, oh, how do I get more depreciation this year? And I'm like, well, wait a second, hang on. Are we sure we want to do that? Are we sure that that's the method? Let's see. Let's see. So this is an interesting question and does lead a little bit to depreciation. And this is why, so this is my general advice. Again, work with a CPA. This is not advice, actually. Let me caveat. I don't give financial advice. This is just kind of my explanation of this. So deducting, if you own your home, right? There are a couple of different ways that you can deduct your home office if you work from home. There's something called the simplified deduction, which is just number of square feet times an amount, right? And that's what your deduction is. And I think it maxes out at maybe 1,500, something like that. Or you can go with actual expenses, which is taking a portion of your mortgage, maybe figuring out the square footage of your office versus the square footage of your home, applying that to your mortgage, applying that to your utilities, all of that. You might yield a larger amount. But what you're also doing when you're doing that is you're kind of depreciating your home office, right? You're taking depreciation on your home office as part of your actual expenses. That's really what it is. So it's not even really taking a portion of your mortgage technically, although it kind of feels like that. What you're really doing is depreciating depreciating your home office, which is weird because it's kind of contained within your house, right? But it's for business purposes, you're able to like take some depreciation on it. But then, which you're like, oh, great, I got a bigger deduction. But then there's something called depreciation recapture. If you sell your house down the line, which most of us will, depending on a lot of facts and circumstances I won't get into here, you may then have to recapture that, meaning, especially if your house, if it went up in value, right? Because usually that's what happens. So you're depreciating. Depreciation, the kind of, the philosophy behind depreciation is that you buy something now and it will be worth less later, right? So it makes sense for cars, for machinery and equipment, for computers. All of those things you buy now, they have the most value when you buy them. Your home is oftentimes an appreciating asset. So you can depreciate it for tax purposes to get this like home office deduction. But then if you sell it and, oh, by the way, it's actually worth more, now you got to recapture that, because you actually shouldn't have taken that depreciation basically at all, right? Because it did not decrease, the value of your home office didn't decrease. So that is why if you own your home, I typically, even if, like my home office deduction would be quite a bit more, honestly, if I actually did it, if I did the long way, the long haul way and used the actual, my actual expenses. I take the shortcut method because you don't have to do depreciation recapture then. You just, it's quick and easy, quick and dirty, right? Easy calculation. What's my square footage times an amount? That's my deduction. And I don't have to track anything else. And I don't have to worry about what happens when I sell my house. And I can tell you, people don't realize that. And oftentimes they'll just take, this is another one of those things where you want to work with someone who understands this so they can tell you about the risks of it. It's not always about what's going to reduce your taxes the most this year. It's about what's best in the long run. We've got to think about that when we're doing our taxes. Yeah, right? And Christina does, you know, she's in this world as well. So she's one of my preferred vendors and she uses that option too. So even people who are well-versed in this stuff, I'm a CPA. And I'm like, I'm not touching that with a 10-foot pole, right? Sometimes they give you those simplified options because they're easier and they make life simpler. And I'm a big fan of simple. I'm a big fan of simple, you guys. I think we overcomplicate things sometimes with taxes, but it can be worth, you know, if there's a huge disparity, it can be worth sitting down with someone and looking into it. And seeing what would make the most sense for you specifically. I'm a really big fan of people talking about their specific situations. When we're talking about assets, when we're talking about depreciation, this is not don't try this at home, okay? This is not a DIY, your own thing here. You want to work with a professional. You want to work with one that understands both the short-term and the long-term implications of the decisions that are made. Because that is something that we're doing our taxes and we're like, I don't know, I'm just going to pick something. And those little in the moment, I just got to get this done decisions can have repercussions into the future that we need to be aware of. I agree. Yeah, if those conversations aren't happening, right? If you're, and again, if you're bringing these and you're not really getting any good advice or you don't feel confident in the advice that you're getting around these things, right? They seem like wishy-washy and they're not like, what I would think would be if you go to your tax preparer, right? And say, and bookkeeper as well, but often this might be a little bit, not necessarily in the expertise of a bookkeeper because you're really more looking at the tax piece of this. You say, I want to buy a car. I want to buy an asset. I need your help figuring out the best tax advantage way to do that over the long term, right? Not just this year, because sometimes they want to make you happy, and most business owners are happy when they save money this year, but you need to sometimes tell them, look, I'm looking for what's going to make the most decision over the long term. Can we look at this? And they should say, yes, absolutely. And here are the things I need to see from you and the information that I need in order to help you make this decision, right? And it should be something where you have some confidence. Maybe there's some calculations they can show you, right? That will give you an indication of where you could go and what you should do. That's how those should work out. If you don't have people like that in your life to ask those questions to, I do have a preferred vendors list. Christina, you want to throw it down there? If you want to throw the link to our preferred vendors list where you can find somebody who can help you with these types of things and these types of questions. Yes, absolutely. Don't try to sit home. It's like one of those. I think you need to understand how it works. And that's why I do this type of teaching. I teach because I think business owners need the basic understanding of these types of things in order to be able to determine if the right things are being done for them and to be able to ask the right questions of the financial service providers in their life. You don't need to be the one doing it, but you need to be aware enough to know to ask about it, right? Thank you, Christina. So that's the preferred vendors, jamietroll.com/preferred-vendors. That is where you can find a list of all of our preferred vendors who can help you out with things like this. So some of them do one-off consults. Some of them you could get and work with them routinely. I do think it's a good idea to work with someone routinely, in your business, because these things come up more often than not. And again, we want to be able to make decisions quickly, and it's really good to have somebody that, is there that can help you, point you in the right direction, and be thinking about all the things that you can't keep in your head and you can't think about, right? They can help you figure that out so that you don't have to hold all of that information in your head and try to figure out 179 deductions and all the like. Okay, guys, that is it for today. That is my chat on depreciation. Again, next week, I think we're going to do a little bit of a party. We're actually celebrating because financial literacy for women business owners is turning 2. So next week is roughly our 2-year anniversary. So like I said, I'm going to be with my team. I'm not going to be here next Wednesday because I will be driving in the car on the way back. But I think on Tuesday, it probably won't be at this time on Tuesday, but I think on Tuesday we are going to be doing a little party in the group, maybe with some giveaways. You can also meet my team. I would love to see you guys there. It's going to be super fun because I'm going to be with my team doing a little team retreat and actually meeting some of them in person for the first time, which I am so excited about. So, all right, you guys are amazing. Thanks. Yeah. Happy birthday to the group. It's everyone's collective birthday. We can celebrate together. And let's see. You guys are amazing. You guys are amazing. And Sarah, you've been here for a while. I would love to see some of our OGs like show up for us. If you've been here since like June, July of 2019, come on. Or even if you haven't, I want everybody. Ooh, I like that. Taco Tuesday. It's on Tuesday. Oh, and actually, I think we're getting tacos right before that. I like it, Stacey. All right, you guys, you're amazing. I will see you back here next week again at a different time. Yes, you are, Diana. You are for sure an OG. Yay. 2 years later, isn't it crazy? You guys are amazing, and we will talk later. Bye.